Yo, what is up? So in this video, I'm going to be explaining a fractal model using IFVGs. And by fractal, I mean that it is executable on any time frame. So let's start. So if in any swing leg, if the highest time frame fair value gap or fair value gaps get inverse, then we should be moving to the next swing lower high. Now, what does that mean? So in this example, if the highest time frame bullish fair value gap gets inversed in this swing leg, we should deliver to the swing low with decent high probability. And by decently high, I mean around 60 to 70% of the times we should be delivering to this swing low. And by delivering, I mean that price should go and take out the swing low or maybe move below the swing low. Now in this example, if the highest time frame bearish fair value gap gets inverse, we should deliver to the swing high with the same probability. Now let's see on the chart some examples that will help you understand what I mean by this. I'll just cut the chart from somewhere around here. Let's see. If I zoom in, if in this swing leg from this low to this high, if this particular fair value gap, this is a 5-minute fair value gap, if this gets inversed, we should be delivering to this swing low. This got inversed here. Now we should be delivering to this swing low. We delivered to this swing low. Now we wait. Okay. In this swing leg, from this high to this low, we can see there was this fair value gap that got created. If this gets inversed, you should be moving to this high. Now this is a volume imbalance. I will explain in a later video. If this also gets inverse, then I'm sure that we should be delivering to this high. We haven't inversed the volume imbalance. We've inversed the volume imbalance. Now we should be delivering to this high or this high, because this is a new high that has gotten created. So this high becomes the 70% probability high. This is another high that price should deliver to if we take out this high, because between this high and this high, there are no other fair value gaps. This high got taken out. Now I'm waiting for price to take out this high. Now this is a new fair value gap in this leg. This fair value gap. If this gets inverse, then I can say that price should deliver to this low. Now price should deliver to this low, and it took out that low as well. Now I'm waiting. Now there is a new swing leg from this high to this low. If price inverses, now you can see there are multiple fair value gaps. So I'm just drawing one combined fair value gap for both the fair value gaps. If both these fair value gaps get inverse, then I think price should deliver to this high. I haven't gotten a candle close above this. This is not a valid candle close because the candle opened here. It did not close here. I am still waiting. Now you might ask why I am not considering this fair value gap, because this is a fair value gap which is an internal fair value gap. I'll explain when I'm explaining my strategy. I don't care if this gets inverse, because this is the fair value gap, the bigger one, which is holding price. If this gets inversed, I should be delivering to this high. Now within this, there's also a bullish fair value gap, this one. Now there are two fair value gaps in the picture that are important. This bigger one on the left of the chart. If this gets inversed, I'm going to this high. This decently good size fair value gap on the right of the chart, if this gets inversed, I am going to the low. So now we have two conditions. See, this got inversed and the low got taken out instantly. Now I'm waiting. Now if this fair value gap gets inversed, I should be delivering to this high. See, this fair value gap, as soon as this got inversed, we delivered to that high. This is how you figure out price with this model. Now this is a decently high win rate model that one can use, but it is the building block of my strategy. If you understand this model thoroughly, then understanding my strategy in the later videos would be very easy. But this is a very simple model to understand. That is what I feel. Why I am not going above the 5-minute chart to find out fair value gaps on the 6-minute, the 7-minute. The general rule of thumb is that on the lower time frames, so 1 to 5 are the lower time frames, 1 to 5 minute. If you're looking on those charts for entries, then you need not look at the 6-minute chart, because if the 5-minute fair value gap gets inversed and there's a 6-minute fair value gap as well, there is a high probability that the 6-minute one would get inversed. Like, you can look at all other time frames. I'm not saying you should not, but the general rule of thumb is that you cannot look at all the time frames all the time. So you should be looking at 1 through 5 for entries. The highest time frame fair value gap within a leg gets inversed and you can enter.